Hey everybody, Elliot from Ace Properties here, and we are going to, in this video, take a quick look at how to analyze a deal. So how we analyze a deal, how we crunch all the numbers for you, and how we kind of put together this pro forma that tells you what kind of cash flow you can estimate to expect on a property that you consider to buy from us. Right, so the actual example for this deal was on a property on 4857 Bering Avenue in East Chicago. Great property. This one sold pretty quick. I think within 15 minutes of us sending out the email to a group of buyers. It's a 3-unit building, and each unit, as you can see here, has 1, 2, and 3 bedrooms. And here's the current rents. That's the most important thing we look at first. What's it renting for? And it's renting for $400, $500, and $740. These are low rents, folks. $1,640 gross. The market rents are $550, $650, and $825 on this building. I would say pretty easily, even if these are a smaller 1 and 2 bedroom unit, and these could even be a little bit higher. But let's go ahead and take these gross rents of $1,640 and get started. We plug them in here to this pro forma analysis of the property's present condition. $1,640 rents brings you to a 9% management fee of $147.60 a month. Our property manager charges a flat rate of 9% for all of our clients. A little bit of a discount from her normal 10% rate because we send her a lot of volume. Property taxes are the next expense that you're going to subtract from that $1,640, and these are actual property taxes from the website. It's $1,540 a year, or $128.33 a month. And I should say these are from the county website. I'm sorry, I said just from the website. These are the county's actual records for property taxes for the year 2018 to be paid in 19. Insurance, $80 a month. We've worked with the same insurance provider for a while. It's pretty easy to predict what the insurance quotes are going to be per property. They do vary slightly. 80 is a pretty conservative estimate for this property. Owner paid utilities. Now, we actually got this from the seller, and we called the utilities company and verified. The only utilities paid by the owner on this property are sewer, water, and garbage for these 3 units, and they come out to be $75 a month total for all 3. And folks, this is very inexpensive. We talked about this in a previous video. When you're choosing an out-of-state market, you got to have a market that offers properties with low taxes and low owner paid utilities. These are going to let you keep all this cash flow, because you can go to Cleveland and Detroit and Milwaukee all day and get these rents for this property value, maybe a slightly higher value, and you're going to pay a $200 tax bill, maybe $250 on a property like this, and you're going to pay a $300 utility bill just for sewer, water, garbage on a property like this. So you're going to keep your money investing in Northwest Indiana because these taxes and utilities are low. Now, we put in a vacancy and maintenance budget. These are reserves, funds you're meant to keep aside for future vacancies and future maintenance expenses. This doesn't mean you're going to spend these every month. It could be higher some months, it could be lower or zero on other months. This is an estimate of how much we expect you to spend on vacancy and maintenance long term. Now remember, all these estimates, this 5 and 10% here, these are our estimates here. Feel free to bring your own to the table. If you want to be more conservative, plug in your own numbers and see what the ROI pops out to be. But on this property, priced at $115,000, which we feel confident it will appraise for very easily, using financing with 20% down through U.S. Bank's commercial department. That's our preferred lender that we require our buyers to work with if they're using financing. They know our process and they're pretty inexpensive. 20% down, 5.75% interest rate. 25-year term. This property is going to go ahead and bring you a 20.05% return every year. That's after paying the mortgage and all the expenses. And that's with these low rents of $1,640 a month, folks. These rents are going to get raised over time. That's your goal with this property. The roadmap to success here is in raising these rents, and the market rents are $2,025. That might take, I would say, just to be conservative, call it 18 to 24 months to get these up there, because you don't want to just kick tenants out and do some cleanup to these units and have a vacancy just to raise it to market rents immediately. You want to make gradual increases as leases come due. And on this property, I would say go ahead and increase it slowly, maybe to $1,840, $200 more within the first year. And at $1,840, you're going to get a cash-on-cash return of 27.98%, almost a 28% predicted return using these estimates here on a rental property that's in good condition for only $115,000. That's a very high return, folks. And when you do eventually get this up to the 2025, you've got a 35% return on this property, above a 35% return. And that's astronomical. That's something that's going to beat the stock market by 4 to 5 times on average. And that's something that you're not going to find in other markets. This is an excellent rental product. It's no wonder this property sold within just minutes after being sent out to our pool of investors. And also, it does meet our lender's cash flow criteria. We've got this, does it qualify for a loan section? U.S. Bank's commercial lending department is notoriously conservative about making sure properties cash flow and are safe for them to lend on. That's good for you because they're not going to let you buy a property that's not going to cover its own debt, right? And what you've got here is a debt coverage ratio. If the mortgage is $400 and they want a 1.25 debt coverage ratio, that means they want your total profit before paying that mortgage, but after all the other expenses, to be $500. So they want your net operating income to be 1.25 times your monthly mortgage, right? This property's net operating income is 1.54 times its monthly mortgage. That's with the low rents of $1,640. They're going to see this as a very safe investment, and you're going to go ahead and raise these rents, and it's going to be an even safer investment for the bank and a safer investment for yourself with a high yield. So when you're looking at these properties, the big thing we're looking for is accurate expenses, a good prediction of current and potential rents, an idea of how we get there and how long it takes, and ultimately your return on investment. This 20.05% and this 35% return on investment are the biggest deciding factors when you're looking at a property. And that's about it. Pretty straightforward. We'll provide all this information to you along with a bunch of other information about a property before you even have to consider it. All this will be prepared, right? So that's about it for this video. Thank you for tuning in.